Ever wondered if you can get a lump sum from your state pension? Stay tuned as we unravel this query. Before we dive deeper, remember to hit that like button, subscribe to our channel, and drop your thoughts in the comments below. Today we're tackling a common question among future retirees. Do you get a lump sum with your state pension? We'll explore what the state pension entails and whether a lump sum option exists. This video aims to clear up confusion and provide you with the knowledge you need as you plan for retirement. Understanding your pension options is crucial for financial planning, and we're here to help simplify these concepts for you. The state pension is a regular payment from the government most people can claim when they reach state pension age. It's based on your national insurance record. However, the specifics of how it's paid and what options you have can be a bit complex. In today's video, we will dissect these details and focus specifically on the possibility of receiving a lump sum. Let's begin by addressing the primary question. Do you get a lump sum with your state pension? The short answer is no. The state pension is designed to provide you with a steady income in retirement, not a one-off payment. When you reach state pension age, you'll receive regular payments which are intended to support you throughout your retirement years. However, there are some nuances to consider. While the state pension itself does not offer a lump sum, you might be thinking of the option available with some workplace or personal pensions, where you can take up to 25s of your pension pot as a tax-free lump sum. It's important to differentiate between these types of pensions and the state pension. Understanding your pension can be tricky, especially with the various types available. The state pension is funded by the national insurance contributions you make during your working life. This system ensures you receive a predictable amount based on your contributions record, but it does not accommodate a lump sum payment. For those who are looking for a lump sum to cover immediate expenses or investments upon retirement, exploring other pension options is advisable. Personal or private pensions often provide more flexibility in terms of payment options, including lump sums. Financial advisors often recommend reviewing your entire pension landscape to make informed decisions that suit your personal financial needs. If you're nearing retirement age and considering your financial future, it's crucial to understand how your state pension will contribute to your overall retirement income. Remember, the state pension provides regular payments that can help cover living costs in your later years, but won't offer a large initial payout. Many people also wonder if there's any way to increase the amount they get from the state pension. While you can't receive a lump sum, you can defer your state pension. This means you delay taking it when you reach state pension age. For every 9 weeks you defer, your future weekly state pension increases by 1. This could be a strategic move if you're looking for a higher weekly amount later on. Additionally, it's worth checking if you have any gaps in your national insurance record, as these can affect the amount you receive. You may be able to make voluntary contributions to fill these gaps, ensuring you qualify for a higher state pension. In summary, the state pension is a foundational part of retirement planning, but does not offer a lump sum option. For those looking for lump sum payments, examining other pension arrangements is necessary. Always consider seeking advice from a financial professional to explore all your options effectively. As you plan for retirement, keep in mind the importance of understanding each component of your pension. The state pension provides a steady stream of income, which is essential for ongoing expenses, but exploring additional pension plans is beneficial for those who prefer the flexibility of a lump sum. Considering the topic, let's explore the advantages and disadvantages of not having a lump sum option with your state pension. One advantage of receiving regular state pension payments rather than a lump sum is financial stability. Regular payments can help you budget more effectively, as you'll have a consistent income stream every week. This predictability makes it easier to plan for expenses and manage your money in retirement. However, a disadvantage is the lack of flexibility. Without a lump sum option, you may find it challenging to cover large, unexpected expenses or invest in opportunities that could arise. You are essentially locked into receiving smaller amounts, which might not meet all your financial needs or goals. Another advantage is that regular payments can potentially lead to a longer-lasting pension. Lump sums can be quickly depleted if not managed carefully, whereas regular payments ensure you have an ongoing income throughout your retirement years. This can provide a sense of security about your financial future. On the downside, regular payments mean you might not have full control over your pension wealth. With a lump sum, you could choose to invest or use the money as you see fit, potentially increasing your retirement funds if invested wisely. Regular payments do not offer this opportunity. An additional advantage is simplicity. Receiving regular payments eliminates the need to make complex decisions about how to invest or manage a large sum of money at the start of retirement. For many, this can reduce stress and make retirement planning more straightforward. Conversely, the main disadvantage of not having a lump sum is that it might affect your ability to pass on wealth. A lump sum can be part of your estate and potentially inherited by your loved ones, whereas regular payments cease upon your death, with limited benefits for dependents. Another benefit of the regular payment structure is that it helps to mitigate the risk of inflation over time. The state pension is adjusted annually by the triple lock system, which can help maintain the buying power of your payments against the cost of living increases. However, the disadvantage here is that if you have other sources of income that are not as stable or protected against inflation, you might find the fixed nature of state pension payments insufficient to cover all your retirement needs, particularly as costs and personal circumstances change. Before we move on to the rest of the video, if you are finding this helpful, please like, subscribe, and comment, as it really helps this video reach a wider audience. Here is a case study related to the topic of whether you get a lump sum with your state pension. Meet John, a retiree from Manchester who had concerns about managing his finances with just the regular state pension payments. Understanding that the state pension alone might not cover all his needs, especially with unexpected medical costs, John looked into alternative solutions to complement his state pension. John decided to continue working part-time even after reaching the state pension age. This decision allowed him to defer his state pension, thereby increasing the weekly payments once he decided to claim them. In addition to this, he invested in a private pension during his earlier working years, which offered a lump sum option. This strategy gave him access to a lump sum that he used to pay for his immediate needs, while his increased state pension payments and part-time income provided a steady cash flow. If you're concerned about relying solely on your state pension, consider looking into similar strategies. You might think about deferring your state pension to increase your future payments, as John did. This can be particularly useful if you have other sources of income in the short term. Additionally, explore setting up a private pension if you haven't already, which can offer both lump sum and regular payment options, giving you more control over how you receive your funds. Another actionable step is to review your national insurance record to ensure you are on track to receive the full state pension. If there are gaps, you might want to make voluntary contributions to fill these gaps. Planning your retirement with both your state pension and personal savings in mind can provide a more comprehensive financial safety net. If you found this video useful, please don't forget to like and subscribe. It helps us a lot and ensures that we can continue to bring you valuable content. We really appreciate your support.